Thank you very much, Stephen. Well, South Africa's real GDP growth growing by 0.4% quarter-on-quarter in the first quarter of this year has been disappointing, at least for some individuals. The latest data print, after contracting by an upwardly revised 1.1% previously in Q4, is still far from the required levels of growth that will boost exports and service delivery and add jobs to the economy. Many believe that the modest rebound in Q1 is likely to be short-lived as load shedding intensified in Q2, weighing on confidence and disrupting operations, driving up production costs for many. Sifiso Skenjana is an economist and founder of ESG Analytics, and he joins us now to weigh in on the latest GDP figures. Thank you very much, Sifiso, for joining us as always. Clearly, this is a disappointing set of numbers, and we're seeing that Q4 has been revised upwards. Can we expect that we could see in a couple of months' time, the next time we hear from SSA on Q2, that Q1 could be revised upwards, even though we have unrelenting load shedding, and I think we've only had one day without load shedding since the beginning of the year?
Thanks, Glennie. I mean, we did hear from the Reserve Bank Governor, of course, that we expect load shedding to shave off about 2% of GDP for the year. But when you look at those revisions specifically, a good bulk, I think 90% of it comes from a revised export number, and that would come on the back, of course, weakened currency over the time. And I mean, if you follow the developments that have come through in terms of the pathways for the currency, we've initially anchored it, and this is about 6 months ago at 1640, and now looking at the levels that now we are now worried about it hitting 20. And so to the point that you're asking, will probably be grounded whether or not we expect continued weakening in the currency, with elections still coming up, with all of the geopolitical developments that are taking place, etc. I don't think Rand is going to revert to its intrinsic value at this point in time, which is probably below around 17, and so we're probably going to see a continued weakening on the currency, and therefore we may see some reversions coming in on the back end of that. And to that point, and then it really comes into then this particular print as well, in saying that when we look at the print, where did some of the salient, I guess, numbers come through in terms of, interestingly, comparing the previous quarter and this quarter, we had seen increases in imports as well as increases in exports. This quarter, we've seen a material decrease in imports. I think it's about a 1.3% decrease in imports and an increase in exports. Of course, that's usually because when your currency gets weaker, it becomes relatively more attractive in terms of the export markets. And so when you look at the role of the currency as well in terms of, I guess, creating what I would call an oversized sense of confidence around the real developments and the real shifts that are taking place in the economy, I think certainly a lot of the developments that we are seeing are not of our own making, but rather shifts that are taking place that, of course, have got a direct impact on our economy.
Certainly, these pressures combined with the downturn in global growth will hurt production, particularly as you've talked about exports, even further in the quarters ahead. So the forecast that you are seeing for 2023, I want to put your head on the block here, because we've heard from the Reserve Bank, we've heard from the IMF, World Bank, all of them saying the forecasts are below 0.3% for the entire year. Looking at the impact that load shedding has had and the weakening currency, where do you think we will fall? I know we still have 3 more quarters to go.
Sure. I mean, where are our export-heavy industries, right? Agriculture is the one that's taken the biggest hit in this particular print. I mean, you know, our colleagues in the agri-space, Wandile, for example, has really, I think, released recent content around particularly the role of service delivery and how it's impacted the delivery of goods. But I mean, in the citrus, just deciduous fruits market in general, I think we delivered about 180 million cartons of citrus coming out of that particular subsector. When you then, of course, are slowing down the production capacity in a localized context, it makes your export competitiveness as well weakened. When you look at automotive, what's happening, of course, if you look at what's happening in Europe in terms of pressure for internal combustion engines and exporting or importing from countries who are still manufacturing internal combustion engines, when we think about the just transition and all of those things, that means there's downward pressure in terms of export manufacturing for South Africa for vehicles. The US is also a destination for our vehicle exports. We know what's been happening with Brigati. And so really, I think when you look at that particular export context, I think it does have some downside risks. It may be, I think, as I said, superficially, I guess, buoyed by a weakened currency. But I think we certainly aren't doing the things we need to do, I think, to deepen production capacity in our localized economy to be able to take advantage of those, I guess, revealed comparative advantage, often called the RCA, in the context of how we then participate in the global economy.
Sifiso, you've spoken about the impact of the weakening rand on the economy. You've spoken about the impact of on exports. Let's talk about interest rate hikes. This is something that everybody is really worried about. Recently, the Reserve Bank Governor, Lesotho Kganyago, says that you need to deal with the monster that is inflation before you can actually decrease interest rates. A number of people will disagree with that, but what impact does that have on economic growth, particularly on the country's output?
I mean, it's quite an interesting one, and certainly I think we're not going to, I guess, double down on the conversation around the Reserve Bank. But when you look at how currency and the level the level of interest rates in the economy interact, there's some literature that actually suggests that, particularly now where we find ourselves in a space where when oil prices are remaining elevated, OPEC has come out and they've given signal that they're going to continue trying to push supply downwards, which means those prices will remain elevated. That's oil prices. The second then is simply then it means that also in the context of our economy, when we're looking at our interest rates, we're seeing also that the upward pressure coming through, that in essence the Reserve Bank has said that they'll contain inflation at whatever cost, in essence. What that translates to is actually that the findings are the cost of energy as well as the cost of capital, which is often associated with the level of interest rates, are actually substituting effects for labor. And so what we may see is that even when we see a blip in terms of positive economic output growth, which is what we're seeing now in terms of GDP, there's a substitution effect that is happening from a labor, and this is why unemployment numbers are going backwards. And so both, then it's almost a double whammy, is that energy is a substitution effect for labor as well as the cost of capital. And these are some of the things that we need to think about in the basket of the complexities that we're finding. And this is why you can have, in the South African context, jobless growth. This is what we've spoken about before, and says that the pundits would say make the economy grow and jobs will follow. I think we need to take a contextual view around the structure of the economy and the structural components and the configuration that will inform that. And so certainly I think when we look at what's happened with oil prices, what's happened with interest rates, and then that's got a downstream impact on employment outcomes. Two things are interesting, Glenn, is that when you look at quarterly employment statistics, there's a substitution that's taking place from full-time work to part-time work, and that's firm choices. When you look at BankServe numbers on take-home pay, that is down 4.5% year on year. These are the things, and when you look, interestingly enough, on the latest GDP numbers, household expenditure on restaurants and accommodation is up 6.5%. It means load shedding is pushing people outside of the houses on lower pay that is currently coming through. That's telling you that certainly I think there's downward pressure in terms of what we can expect coming out of our economy going into the next quarter.
You started by saying you don't want to get into it with the Reserve Bank, and you just went right there. And it's something that is quite interesting as well, that the households are under immense pressure. You've touched on a bank serve, household income, household index, and take-home pay index rather, and it just goes to show that the income is going down. But on the other hand, you also see the other indices showing us that the middle class is heavily indebted. So this is all bad news. Even when we are saying 0.4% growth quarter on quarter, it's still jobless growth. We still don't have any electricity. Just one day without power, without load shedding since the beginning of 2023. Is there a silver lining anywhere in this data?
I mean, so I'm struggling to find it right now. When you look at the kind of the large contributors of our inflation numbers overseas, food inflation, we're expecting El Nino to come in next year. That's going to be a big pressure point on levels of price levels for food. Administered prices, and this is now the real feel in essence. So don't worry about the fact that our basket, our food inflation basket, is not reflective of the fact of kind of the lived experience of South Africans. Most poor and middle income households are mostly impacted by cost of transport, cost of food, and administered prices. So that's, of course, water, electricity, etc. That's not going to come down. Food is not coming down, and definitely then transport, with petrol prices remaining elevated, is not going to come down. So using monetary policy to try cool that is going to certainly be a blunt tool. But what you're going to continue doing is squeezing those households. And then on the tail end, of course, you're squeezing business, because then they've got cost of capital, which then results in the negative employment outcomes as well. And so I think we need to look at a basket. We need to take systems thinking when we're looking at these things. And yes, no one's saying change the mandate of the Reserve Bank, but we've got to look at the broader picture and the bigger picture and understand all the transmission mechanisms that are embedded in any of the choices that we're making. And that will tell us then that we've got a difficult reality right in front of us, and we've got to be a little bit more innovative in how we use these tools to try, I think, ignite opportunities and pockets of growth. Are there opportunities in South Africa for growth? Absolutely. I mean, when you think about, we talk about the just transition, platinum group metals, in terms of supporting the hydrogen economy, they're coming through, offering a lot of opportunity there. There's a whole lot of opportunities that we can think through in terms of supporting, I think, economic growth in the context of our economy. But if the strategy is not right, we can write policies, but it's got to be the strategy. It's got to be on the balance of choices. And I think right now that's probably one of the things that is missing, is that balance of choices that can enable us to make sensible choices around how to optimize the appropriation of the resources that we've got to support sustained growth.
Sifiso, I think you've just touched on something that has been a historical problem. Great policies on paper, implementation nowhere to be found. Sifiso, thank you very much for your time. Sifiso Skenjana is an economist and the founder of ESG Analytics, and MD there, talking to us about, of course, the latest GDP print, which has shown an upwardly, optimistic 0.4% growth in the first 3 months of the year when it comes to our economic activity.